We've done life insurance before, but you've kind of taken it to a new level of like, hey, what are we talking here? What's available? What's possible in the space?
Now with the living benefits, it's not just about you dying.
This is awesome.
We spent almost $6 trillion post-pandemic. We're all going to take somewhere between a 16 and 25% increase on federal income taxes in 2026. Inside of a life insurance policy, we're able to access money tax-free, but not have to worry about federal penalties.
Your mindset has to be different than a term policy. When you go into an IUL, it's how much can I fund this without triggering IRS guidelines.
Having complete flexibility and being able to put together very tailored plans.
This is the creative side.
Another very key piece of the puzzle is annual reset. And I can't really stress enough annual reset.
I love this. Hello, everyone, and welcome back to another episode of Risky Assets. We're extremely excited about today. Charlie Deaver and myself, Justin Pizzola, have invited Hobie Beman from Midland National. And I personally have known Hobie for about 10 years, doing a lot of life insurance deals with him, especially when it comes to the high net worth and creative solutions. And just wanted to say we're extremely excited to have you.
Glad to be here.
Yeah, thanks for coming, man. So really interesting concept because we've done life insurance before, but I think for me, you've kind of taken it to a new level of like, hey, what are we talking here? What's available? What's possible in the space? So Justin said, hey, we got to have you. Here you are. Thanks for coming. And let's talk, like, what's your background? Like, how did you get to where you're at now? Where did you start?
Sure.
And let's go from there.
Sure. So this year will be my 21st year, right? Lucky number 21, blackjack.
Heck yeah.
In life insurance. And really, it's been most of my adult life, right? From the time I got into the space very early on while I was a college student. And it was looked at as kind of initially a part-time thing. And I think within the first 6 to 12 months of me being in the business, I was doing better than either one of my parents in their business. And I was going to school for a career. And I had seemingly found that career.
So you were doing life insurance in college?
I was.
Okay.
I started just after my 19th birthday.
All right.
Yep.
That's awesome. And what company was that for?
So that was with a captive agency where we worked with about 5 or 6 different carriers, and they were based out of Southern California. And we were doing mortgage replacement, right? So we were doing basically mortgage cancellation.
I hate those letters.
Yeah, right. Yeah. So you cut your teeth with 3-4 appointments every day. 5-6 days a week. You're on the phone 30 to 40 hours a week as well, reaching out to people. So from someone having no experience in the space and being very young and wearing your dad's suit out in the field across the kitchen table, you got a lot of experience very quickly.
Sure.
You learned about people, about rapport, about what's important to them, about different family structures, right? From second marriages to single parents to blended families, and kind of all the different things that are important and not important to them, and kind of how they think. So it was a great first 4.5 years of my career.
Oh wow!
And then from there, I had moved into management and built a team of reps working with them in that space, and then started to move into the advanced planning side of things with higher income, higher net worth, business owner type folks, where basically the reps, as they ran into those people within their weeks, I would then come back in and start to do some more.
Yeah, that's where it gets really fun.
And that's Justin had some recent experience with some of his clients doing that with you, which is high net worth. Hey, let's put in some money and be really creative.
Yep.
And then speaking of family structures, you got a family.
I do. I have a beautiful wife and a 12-year-old daughter who is out of her mind with volleyball.
I love it.
That's great.
Yeah.
Is it like travel?
Yeah, she plays with the school. She plays club, and then she plays against every surface in our house: the roof, the floor, the walls.
Gotta practice.
That's the best part, man. I love that stuff. Well, good. So then from there, Midland, where did that come into the equation for you? And tell us a little bit about Midland, because it's unique in the space, and even for us as brokers, the way they pay us, unique. Just it seems to be a unique beast. So just explain away.
Sure. So I was in personal production for a little over 10 years.
Okay.
Before I moved.
And that was with Midland?
No, that was as an independent producer.
Got it.
So I have written business with all the usual offenders, right? And What happened is in 2006, I started to write with Midland National. I was approached by a regional and basically explained the product portfolio and their structure. And I had started to place some business with them. And then from there, what had happened is I had relocated for an opportunity to work with a very large physicians group.
Okay.
And with the ranching community up in South Dakota. So Sanford Health is a very large, I wouldn't say HMO, but similar to like a Kaiser Permanente or something like that in the upper Midwest. And the group that I was working, that I had the opportunity to join up there, had kind of a direct link or opportunity to work with a lot of their physicians, higher up administration, etc. And so I was able to go back there and do a lot of life insurance planning for them, as well as there are a lot of asset-rich, cash-poor farming operations.
Sure.
Mm-hmm.
And for them, the life insurance planning and estate planning piece is not really a luxury, but more of a necessity, right? Because they need to make sure that they can transfer the land, right, to the next generation so that they can generate income. If they lose the land, they lose their ability to make an income. So that estate planning was an interesting turn in my career, working with those types of folks. And so I moved to South Dakota and started working in that space. And Midland happened to be there, right?
Yeah, their headquarters in South
So
Dakota.
their headquarters are in
Yeah.
South Dakota. So at that point, that was about 6.5 years into my career, and I had was doing some personal production then with this group, with Sanford, as well as a few other organizations for the next 5.5 years. And that's when my relationship with Midland grew pretty tight as a producer.
Okay.
And I was a top 25 producer with them nationally for about 4 years, as well as I had linked up with Ed Slott Elite Advisor Group and had done quite a bit of training and just learning about different tax law, estate law, and just different things that could be done with IRAs, with life insurance planning, and really using insurance or life insurance as an alternate asset class for these different types of people.
Fascinating. So in that 4 years that you were out in nowhere, let's say to some degree you saw something in Midland National because you were a top 25 producer. You don't just do that out of nowhere.
Right.
And then did they approach you? Did you approach them? Like, what did that transitionary period look like? And why did you end up going?
So with Midland National, what I found was that over time, both when I was here in California before and I was writing with them, and then when I moved to South Dakota and was producing for them there, what I found is most of my business was referral-based, right? Or it was network-based, both of which you really don't want to screw up. So, right?
Yeah.
I think in California, a lot of times and in other big metro areas, the idea is transactional.
Yep.
Right?
Absolutely.
Less relational, less referral-based, more transactional, right? If I can find a lead or find a way to just see a lot of people, I can burn people
Midwest
every day,
is not like that.
every day and still make a living and maybe do very well for myself. Totally. Right? Well, back there, that's really not the case, right? You can, you burn once, you burn twice, and then
you're toast.
And then you're burned out, toast, right? You're toast.
Yeah.
So, for me, it was important, right, to keep those relationships. They were great. They were great opportunities for me, my business, etc. So basically what I found was I was apologizing less for Midland National than I was for a lot of the other carriers. So in that case, when the things that I was presenting were coming true more often than not, right, and they were following the plan and what we had laid out and the promises that we had made, that became extremely important to me. In addition to that, the direct nature of Midland National, right? So the fact that it's the insurance company, producer, client, that there's not this pyramid of 4, 5, 6, 7 different layers, and they're a privately held company, right? So the fact that they're not publicly traded, meaning they're not having to try to drive share price on a quarterly basis, which inevitably hurts the policyholder. So that private ownership, along with it being a 100-plus-year-old A-plus rated carrier, and the direct nature of the business, both that I could communicate with the home office and that there weren't, their products were very competitive from the standpoint of if you don't have to pay 10 layers, right? Then the product doesn't have to cost the client as much. There's more upside opportunity. And like I said, just not having to apologize for the plan 2 years, 3 years, 5 years was super important. And And then from there, I left the Midwest because my passions are the water, right? So surfing, right, is a big part of my life.
Did you grow up here in LA or Los Angeles area?
I grew up actually down south around the San Diego Riverside County line, and I grew up going to, say, Oceanside,
Of course.
Carlsbad.
Yeah.
And
Just couldn't stay away, huh?
no. So, funny fact with South Dakota and where Midland is that you are geographically about the furthest you can be on the planet from an ocean.
That's wild.
I think, yeah, if you think about it, Canada to the north, right? No water, right? All the way to the west coast, all the way to the east coast, and then
south.
all the way to the south, right? So you're almost in the center of North America. And like if you took Canada and you just erased the line of the United States, right? You're way up north. So you're literally in every direction as far as you can be.
Yeah.
I think there's one place in Russia or China, I think, that might be like 5 miles further, but
That's not saying a whole lot about South Dakota right now. Just we can move on.
well, there is no state income tax.
Yeah,
they
no,
have
hey,
great
look,
trust law.
of course.
Wonderful people. Low cost of living. There's a lot of, and it's been rated for retaillees as one of the top places
I say that. Yeah, it's just far.
But for me, as wonderful as the business was, the people, everything, being that far from the ocean was just more than I could take. And after 5.5 years,
Yeah, you had to get back.
I moved back. So when I moved back, I went back into personal production for a year, and then Midland had reached out to me to basically be the regional for the West Coast kind of region. So I have Nevada, I have California, I have the Hawaiian Islands. So basically I have Los Angeles Metro, I have San Jose or Silicon Valley, right? Las Vegas is a big hub.
Sure.
And then Oahu,
And that's how you're acting with us. That's our relationship with Midland is through
support.
Hobie. Yep.
Correct.
Yep.
Correct. Supporting independent reps within the space. Right. Correct.
And I guess this is where we go into like what does it mean to the people watching this, right? And I know, Justin, you had a case recently where it really brought up hey, we should be more integrated with Midland and we should have more conversations. High net worth seems to be a very good space for you. You know how to see the money trail, so to speak, and what to do with it, how to understand tax law, what makes sense for the client, different family structures. And then we trust you. You've trusted him forever.
Absolutely.
And I think that's hard to build in the high net worth space because everyone thinks you're out to just take a couple pennies from their pocket. So tell us about that. And how are those people with high net worths utilizing the products you're selling?
And then just real quick to set the stage just a little further.
Yeah.
When I talk to my clients, you think about the entire portfolio, right? You have a circle. Let's call it a pie. And you have all these asset classes of where you could funnel and put money for future growth. So I always tell them this is just a slice of that pie. However, this also brings other products within that investment, and we can get into how it becomes non-MEC, modified endowment contract, and how the IRS lets you play in this space. The point is, beyond just the financial gain, you also have the life insurance side of it. You have the long-term care, the living benefits. So I just wanted to set that stage real quick that, yes, this pie is your financial future, but there's more in this slice when it comes to insurance. And I wanted that word to get out there because this is such a creative space. We can kind of jump into it.
Yeah.
Sure. So, I think when you're talking to higher income, high net worth, or business owners, right, if you kind of group all those together, and I know we'll kind of segment those out, all of them, have different needs. But again, to your point, there are different places that they're placing money, and usually the vanilla has already been handled.
Sure.
Right? So, funding your 401k up to the max, right? Done. Right? Hey, I want to do a Roth IRA, but
Too much money.
I make too much, so I'm not eligible. And even if I were eligible through a backdoor Roth IRA, the advisor doesn't want to do it because there's no money in it for them at $6,500. It's a lot of paperwork.
Totally.
And then when you look at their overall financial situation, even if I do $6,500 a year, it's just not a meaningful piece of their overall of their overall assets, and or it's not going to be able to create enough income in the future to really make a difference in lifestyle or a difference from a taxation standpoint because they're going to have so much income that's taxable that it isn't a large enough piece to be able to manipulate distributions during distribution planning.
I still think they might close that I don't know if the backdoor is going to be available forever.
Sure. So they're actually on the Senate floor on both sides. There has actually been conversations around Roth IRAs, not just from the standpoint of eliminating the backdoor Roth,
They need bigger limits.
but also talking to them about making it provisionally taxable. So a lot of people, when they talk
Fascinating.
about tax-free municipal bonds, they say, oh, they're tax-free.
Right.
But what most people don't understand is that, yes, those are, but they're still provisionally taxable on your tax return. So meaning that it can make all of your other sources of income, right? It can push those into a higher
Right.
tax bracket. So even a tax-free municipal bond is not exactly completely tax-free. So that leaves you just with that Roth, which you're limited in amounts,
Yep.
right? You're limited on being able to take from it prior to 59 and a half. So going back to high net worth, high income business owners, right? A lot of these folks may be in a situation where they need capital for expansion, right? Or an early retirement.
Yeah.
If they're early retiring before 59 and a half, right? They need to be able to have access to that money to be able to take income prior to that, and they don't want to pay government penalties.
Of course.
Right? So that's where the life insurance comes in the fact that you can get a similar type of experience to a Roth IRA in the fact that you can put after-tax dollars away. It can grow tax deferred or postponed. Right. But then you're able to access that money in the future tax-free without all of the handcuffs.
Right.
Right. That a Roth IRA would experience. Things like,
Correct.
hey, I want to open another office. Right. And I need $100,000. But if I touch the gains from my Roth IRA, I'm going to pay a federal penalty, possibly a
tax.
state penalty.
Yep.
Right. So putting all of my money in these qualified plans really kind of, puts the business owner or that high income, high net worth person in a predicament, because if they put that money away, then they can't get to it without paying those penalties.
Exactly.
Well, with inside of a life insurance policy, we're able to access that money, again, tax free, right? But not have to worry about those federal penalties. So having access prior to 59 and a half is a big deal. In addition to that, you really are putting a hedge against their other assets. So when we talk about index universal life,
Yeah.
right? Or you talk about universal life in general, having the ability to be able to take that money out and receive that money tax-free, having the ability to put it back in, right? So that basically after you've paid tax on it once, the money coming in and out of the plan on an ongoing basis becomes never taxed again. Both the distribution, both when you put it back and it grows more interest, etc. So having access before you're 59 and a half, and then, like I said, as a hedge against all of your other assets, we think about years like 2020, think about years like 2022, right? What happened to bonds?
Oh, it took a dive.
Historically, people
Yeah.
say, well, why do I own bonds within my overall financial plan against my equities? The old 60-40, 70-30, right? And for those who don't know, 70% equities, 30% bonds. The idea is that it's a hedge against when the equities pull back, my bonds are there.
Yep.
Well, the bonds took a dive too. Yeah.
So what we saw in 2020 was we saw bonds fall right alongside equities.
Yeah.
We saw in 2022 bonds fall right alongside equities. Well, if you're in a distribution phase of your life, or you're in a position where you're trying to take advantage and you're trying to grow,
Yeah.
or you need that capital, either
It's a
in
huge,
a downturn,
It's a huge punch in the
let's
gut.
say your business needs the money because it is a downturn,
I can't take it.
or let's say that they need the money because you're trying to grow. Well, if the money is in those bonds and they're falling alongside the equities, you're really not in a great position.
Yeah.
Well, inside of the Index Universal Life, having that zero floor or some of those underlying guarantees, it really is a true hedge
Yeah.
against your equities, right?
And for people who don't understand, most of the policies, if not all of them, have a zero floor, which means like, hey, the market's down 20%, you're at zero.
Correct.
Which is
Right.
such a big deal. And some of them offer like plus ones where you're at least earning 1% on top of that. There's a lot of those
Sure,
different
minimum
things.
guarantees.
Minimum guarantees, which
Yeah,
are awesome
so
IULs.
so real quick, IUL, you said it. So
Yeah.
Index Universal Life, just
Yep.
for you out there, known as IUL. So if we reference it, it's Index Universal Life. Stating that, can you walk us through a product design for an IUL, kind of from start to how it works, and then kind of wraps up?
Right. So basically, what we're doing is we're going and putting together a plan, and we're saying, the traditional way to look at life insurance is, hey, I want the biggest death benefit I can get
Yep.
with the most amount of living benefits, things for like in-home care, assisted living, care in a facility, right? And all the other things like critical illnesses. If I have a heart attack or I have a stroke
Yeah.
or cancer, everyone is seemingly getting cancer, these living benefits. So I want the biggest right? Death benefit. I want the biggest living benefit I can get, and I want to put the least amount of money or contribute, right? I want to contribute to it the least amount that I can monetarily, and I want to have the biggest benefit. So that would be, that's the idea behind insurance.
Yep.
Well, the idea of using insurance as a tax shelter, using insurance as an alternate asset class or a bond alt, right, is just quite the opposite. We're trying to basically go to the IRS and say, what is the least amount of insurance, right, that we can issue to take advantage of certain tax codes like 7702, so that we're able to put the money inside of this tax wrapper, grow the money tax deferred with the least amount of investment drag, aka cost of insurance, right? So the lower the cost of insurance, the lower the investment drag, much like your 401k. If you're paying 1% in fees and you look out 10 years versus if you're paying 2% in fees and you look out 10 years, it makes a big difference.
Huge difference.
So the idea is we're trying to push the amount of insurance down, right? So we have the least amount of investment drag, the most amount of growth, so that the client can then access that money at different points in their life, at different junctures where they need capital, maybe for their business or their kids or college or retirement distribution income, in a tax-free way with the least amount of handcuffs on how they can access the money. So that's really the idea behind Index Universal Life, and that type of planning as an alternate asset class is basically we're turning it on its head and we're saying let's push as much as we can in there, get the growth, and then have access to it, while at the same time providing us with benefits that we all know that we need. We just don't want to pay for, right? You don't want to buy life insurance. I don't want to buy life insurance, and neither do you. But at the end of the day, you love somebody, right? You pay a premium. Yeah. And if you're not here or you're incapacitated, their life and your life is different for it. And that's simply an unselfish act of love, right?
And as I get older and have more kids, there's not even that, like, I now want to buy it because I want what I've done to mean something. So I think family planning, you talk about the high net worth space too, all this time that these people have spent to build an empire, have all these beautiful things, they want to pass it down to their kids. I feel like that's a big part of it. Not obviously there's income that they want to generate from it, but they're trying to get an ability to have a big death benefit still, because you can still get big death benefits out of the IULs.
100%.
And then you can say, hey, look, all this cash is available, like you were saying, to do whatever. Look, I've had people buy Lambos with them on the infinite banking, and I've had them really do important things like, hey, I need to float the business a little bit. I need to get some money. I need to pay for schooling, like you had mentioned. There's so many things that you can do with it. I've really come to love the IULs, not just because I'm in the insurance space. I've become really jaded to the pre-tax world of like investing pre-tax. I don't do almost any of it anymore. Anything I do becomes post-tax because I have a general distrust of what's going to happen in the future. So I'm assuming a lot of people are in that space.
So to add to that, I think, the big word, right? I'll look at the camera, right? I think is balance, right? And so many years now have gone on where you talk about qualified plans, you talk about pre-tax, and your CPA uses the word save money. I can save you money on your taxes this year if you put your money away in this IRA or this 401k or so on and so forth. That is just simply not true, right? You're not saving anything. You're deferring, but then also our society has made this deferring procrastination also have a positive, hey, you can defer. Oh, that sounds good. Defer, right? But that means postpone. You will pay the tax and you owe the tax, right? So you need to have balance, right? There is an idea. Look, on a match with your 401k, free money.
You should take it.
You should take
it. That's 100% ROI
right?
day one,
And it is deferred and it is postponed. And so it's going to come out of the highest bracket that you're eligible for, right? But the problem after that becomes, well, wait a minute. If I take a chart or I go online and Google tax rates in the U.S. over the last 100 years, we're in the lowest tax environment that anyone in this room or even our parents were alive to see, right? There was never a time in the U.S. where taxes were lower than they are now. In addition to that, in the Tax and Jobs Act, right, which was enacted in 2018, basically that put us in the current tax brackets we're in now. Every single bracket, from low-income people to mid-income people to high-income people, every single one of those people received about a 16 to 25% tax break at every step of the way, at every bracket. Yeah. And that is now set to expire in 2025 and go back up. So basically what we're saying is it's already signed into law. No one has to agree, right? And it's just set to expire where we're all going to take somewhere between a 16 and 25% increase on federal income taxes just in 2026.
Yeah.
Right? Yeah. So, and then from there, every piece of legislation or every proposal that's come out from there has talked about taxes just being even higher than even what's signed into law.
Well, we keep printing money, so I think a lot of people have that, like, it's got to come from somewhere, and it's like, well,
yep.
When's the time, right?
I think the most interesting analogy that someone has told me that really resonated with me and I think people connect with is when you look, we spent almost $6 trillion post-pandemic. We don't need to point any fingers to, at different people.
One way or the other,
It happened, right?
Yeah.
And I think it was both sides, and it was a situation that the world had never experienced before.
Yep.
And so that money was spent. But then you got to ask yourself, okay, on the $30 trillion in national debt, and we spent $6 trillion, right, to add to the top of that in 2 years. So roughly 15 to 20% of our overall national debt was spent in a 2-year period of time. What took us 100 years to come up with, we spent that in 2 years. So when is the last time in U.S. history that as a people we had spent anything close to that? And the answer, I'll just give it to you up front, was World War II.
Okay.
But if you adjust for inflation, it was only $4 trillion. It wasn't 6. But what happened after World War II? Taxes went to the highest level in American history. The old joke about Ronald Reagan and why do you only make 2 movies? Because taxes were 90% at the highest bracket. Well, I'm not saying we're going back to that. And when you tell people that or you show people that, even if they were alive and they were paying it, they don't believe we'll ever be back there again. But if you just go to a midpoint between the highest and where we're at the lowest, and you go to a midpoint, it's pretty staggering because taxes on average would double from where they are today.
And I think that's where my pre-tax really comes from. Like, it has to go up. There's just no way it can go down. And we've done too many. And we're still giving money overseas, and we're still printing it, and we're still just farming money out of here. That's going to create consequences to me, to my family, to people around me. So I've really... Look, all my kids now have IULs. I have IUL. I want the business when we do our executive plan, IUL. And I think there's something to be said about that. And obviously, when we sell the business, we're going to have a pretty big tax bill anyway. So I'm already staring at it going, that's my pre-tax mechanism anyway, which I'm assuming a lot of business owners will do. So I just think there's a lot of opportunity for people who can really grasp the IUL concept to go, oh, that's where it fits for a lot of people.
To create balance. Because inevitably, you're going to have taxable assets and you're going to have tax-deferred assets, right? So where is that tax-free portion of the plan? Just a quick example, if you think about it now, based on current tax law, the first roughly $100,000 in income, you're at a 12%. It's going to 15%. Right? Well, 3 goes into 12 4 times. Yeah. So that's a 25%, depending on how you look at it, increase that we're going to see in 2026. But if you look at that 12% on the first 100, the second 100 that you would pay tax on goes to 22. So on your first 100,000, you owe $12,000 in tax. On your second 100,000, you owe $22,000 in tax. It almost doubles. So wouldn't it make sense again in any tax environment, because we don't know where it's going to go in the future, that if you're in retirement or if you're in distribution, that you would take tax-deferred or taxable assets and you would take the first 100,000 that you need to live off of from those taxable assets and you'd pay that lowest bracket.
Yep.
But before it doubles, wouldn't it make sense on that second 100,000 to take that from a tax-free side of things? Because inevitably that is going to save you, not the same way your CPA said save, right?
Yeah.
But save you money and allow you to keep more of your hard-earned money, right, to your point, to both for the hard work they've done and then put them in a position to be able to have more to transfer more to their loved ones on a go-forward basis. And so, you look at it, hey, it's a hedge against taxes, we just talked, because now you can have some balance in where you're taking your distributions from, therefore keeping more of your money. It's a hedge against, say, your bond portfolio or your other pre-tax dollars, because when the market falls, here's a zero. So actually, in those down years, you would have an ability to take it, not just on a tax-free basis, which lowers your taxable income, but also from an account that didn't take a negative, meaning you don't have that reverse dollar cost averaging.
Exactly.
I'm not having to sell more shares of something to get the same amount of money so I can live off.
Yep.
And when it turns around, I own less shares.
Well, what's funny is I still have my Roth. It took it in the shorts.
Sure.
And my kids were all converted to IUL, and they were just, my kids did great in comparison to me during that time. I had a direct correlated time frame to go, look at how much I lost, look at how much they didn't. And I'm not even close to back, right? It takes a long time to get back, and now my kids are going back up again. And it's like, that was a perfect example to me of like, hey, it works. The hedging works. Another thing I
as a
I
piece,
think is important.
as a piece, right? I think one of the things I want to make sure that we're clear on, it is not for everyone and all of their money.
No,
right?
it's not.
So many people, it's a one size shoe fits
that's
all.
That's how I opened up. It's a
shove
piece.
everybody into this,
Well, from a
square
sales
hole with
perspective, lots of people in your shoes want all as much money as they can, right? So I think that's where it gets a little too salesy and not truly that real picture, especially with, again, wealthy people to go, hey, I want all of it. And they go, hey, we'll take it easy. It's too much for me. But it is a small piece, and it is a good piece to use. Another thing that I always want to mention, too, so my brother had a pretty big health scare, not insurable, and now at this point he's got enough years not easily insurable. My daughter had some things that were pretty scary, cancer scares, all that stuff early, right? And I always think of getting IULs now. I tell people to get it as soon as they can for their kids and they can afford it, because one, there's that insured, like you are insured forever, right? You can't, no one can take it from you. Pay the bill and it's yours, right? As you get older, right, you get more unhealthy, whatever happens, right? And we've seen that happen in our family. I think the kids' conversation is important. I don't know what college plans are going to do. I don't know what all that stuff's going to do, but I think there's a lot of tools for kids. So whether it's parents or grandparents buying it for them to use it, and that's a long time to compound as well. How are people using that right now from what you're seeing?
Yeah. So, look, first thing I guess I'll just touch on is, for college planning, money inside of a life insurance is typically not a countable asset for FAFSA.
Right.
So a lot of people will say, well, I partially funded a 529 or the SEPMA or this or that or different types of college plans. And then they get to filling out the FAFSA at the college level and they find out, well, because I had partially funded it and I'm not completely paying for their school, right, with that account, now they're not eligible for these different types of grants that are out there. The subsidized loans are not available to them, so now they're paying higher interest rates on their student loans and so on and so forth, where you literally could have $1 million inside of an insurance product, a life insurance product, and it's a completely uncountable asset. So I think just, again, there are advantages to using that in addition to your insurability, right? None of us, look, I'm not saying you're going to die tomorrow, but there can be changes in your life with your health that are unexpected that put you in a position where you're no longer able to get the insurance, or where you're not in control of telling the insurance company how much you want, but now they're telling you. So getting these accounts just simply opened and set up, I can't say enough for. Also, it's a foundational piece of someone's financial plan, right? Everyone needs some insurance, right? And whether it's buy term and invest the rest, you hear that from different people. But notice the first words were still buy term, right? Because people still have a life insurance need, right? And now with the living benefits, it's not just about you dying, right? So I'll give you an example. Texting while driving, I run into a light pole, I put myself in a wheelchair. Well, now with the living benefits, right, I'm able to access, say, 70, 80, 90% of my death benefit while I'm alive.
Right.
So it's one thing if I'm gone, that my family's taken care of. But what happens if I'm incapacitated and now I'm financially responsible for myself, for my family, and I have no way to earn or to take care of them? Well, now the plan is taking care of me and my family while I'm here, as well as in the future. And so if you can get that set up to where your kids have things for critical illnesses, things like a diagnosis of cancer or heart problems or these different types of things that come at you throughout your life, if that's already taken care of and set in place, right? So they're taken care of early on, and they know that they'll be able to take care of their family, right? The same way that you're taking care of yours now. So the foundational piece of having the insurance, having the living benefits, getting started early, right? The whole idea of, if I, do $100 a month at 20 versus $100 a month at 30, and I look at where I'm at in retirement at age 65, right? There's literally a 7-figure difference. So for most people, the idea of just getting their kids on the right path early and having that that foundational piece of a financial plan right away, I think is very important. I just can't say enough about it.
And then do you want to touch on how they could access that money too and what it could be used for? It's not specific to any one segment.
Yeah. So, sometimes, people say, well, I've got the 529, right? But what happens if your child wants to go into real estate investment? They want to be a realtor. what happens if they get a job with the city? They get a great job.
They can use it for classes, but that becomes very limited, semi-inexpensive. It's not college.
Right. So the tax-free nature of those accounts somewhat dwindles, right? What happens if they want to be a photographer and they want to go around the world and you want to give them some money to do that? There's so many examples, entrepreneurial spirit of so many different people. Yep. The world is changing with AI and tech, and will the traditional
traditional schooling
be the way, and what will happen with the tax law there? Well, within an IUL, if my kid gets a great job and I just want to help them with the down payment on their home, I can access money from that policy tax-free for that purpose. If it's just they want to open their own business and I want to help support that from their plan, we can do that. So again, I think it's flexibility.
It's huge.
Right? Foundational piece and having that flexibility.
And then I'm going to ask you this question on how you would handle it, because your mindset has to be different than a term policy. So when you're buying term policy, it's how much life insurance benefit can I get for the least amount of premium I have to spend.
Right.
Versus when you go into an IUL, it's how much can I fund this without triggering IRS guidelines. So when somebody comes to you and say, hey, I want to do X towards this, how do you handle that? Where it's like, this is the cost of it. It's $400 a month. It's like, well, no, we don't look at just like, hey, this is your life insurance. It's $400. How do you actually plan that with them?
Right. So I think the first thing you want to approach is needs, right? Always. So here's the debts that we have. Here's the obligations that we have. If something were to happen to us, right? What is a number that would comfortably get us across that difficult time and hold that family together financially? And so I think once you've kind of discussed what that looks like, then it goes to budgeting, right? How much are you putting away in other qualified plans or other retirement assets or other savings vehicles, or are you investing in a rental home, or what does that look like? And how much do you have kind of on a monthly or annual basis that you can do in addition to what you're already currently doing? Or should we be pulling a piece of what you're already currently doing from somewhere else and moving it over, because you're just doing all tax deferred or taxable and you're doing no tax free? And so we need to reallocate some of those funds. So first you have to look at the need, and then from there you're looking at the total budget. Like one place with a lot of people I talk to is, hey, you're maxing out your 401k, but collectively, right? Like let's say a middle income husband and wife are making about, $200,000, $100,000 each, and they're maxing their 401k and doing nothing else. But the match was only on the first couple thousand. Yeah. Right? So while I'm in agreement that the first couple thousand you're getting that match on, right? The money they're putting into all deferral over and above that, maybe that's not the best place for that money. One, because you're not able to touch it but prior to 59 and a half without some penalties, right? There may be some loan provisions, usually not that attractive, but my point is it's pretty tied up money until specific age. Also, it's all market-based, right? So in bad times, likely, what else correlates to that? Usually the markets are down, so not usually the best time to grab at the money. And then, what benefits does that bring you? So from there, we usually look at reallocating a portion of that. We look at how much more they can put away on a monthly basis that's comfortable, and an amount they can stick with that they know is not keeping them from going out to dinner with their spouse, etc. But establishing the budget from there, and then we back into the death benefit and back into the size of the permanent policy, the IUL. And then a lot of times what we'll do to get to the needs side is we'll supplement it with some inexpensive term for 10 or 15 or maybe 20 years,
and that's
to
get
their
part of
kids
it.
It's extremely important. Out of the home, or get them out of specific debt obligations that they may have on a building or their business, etc.
Yeah, and I don't want to tell people that we don't believe in term. We do. Well, for me, again, I just use myself. 4 kids, private school. They're very young. My wife doesn't work. I have a tremendous amount of liability for not being here. Term is necessary for me. It's inexpensive. Something happens. I have millions of dollars to get my family taken care of. But it's not going to be that way forever. They grow up. They graduate college. One, I'm not paying for college either. So it's you don't have to worry about that. They have IULs to deal with it. And I'm funding that. It's hey, my mortgage is paid down. There's all these things that really start to come off the ledger as a liability. And that's where you really can start to say, hey, term got me through that. And that was important for it. But I get old, and then my liabilities kind of come back. You want to have that growth.
Yeah. That's the needs analysis, right? And that's why you do it, and that's why I wanted to touch on it, because you take those needs and you create a creative solution, right? We're going to take this class, this IUL, and we're going to fund it, and this is what it's for. However, we also got to get you to a certain age with your responsibilities. We're going to set up X amount of years in term. And then from there, however they fund it, whether it's $200 a month, $500, $2,000, $5,000 a month, or pre-fund it, they take from another asset class and they say, hey, let's start this at $100,000, $200,000. Once they do that, touch on how the product actually works. What index does it go into? The floor, maybe the ceiling. What does the life insurance company do with that premium? How are they investing it? Is it day after day? Is it month after month? Can you kind of go over into the actual product?
Sure. So, I'm going to go into the product, but I also want, as a portion of that product, just to finish the needs conversation. So as you were saying, as your obligations and debt kind of come off and the kids kind of get on their feet and so on and so forth, that term can kind of come off. But then as you age, you have some liabilities that come back. From either a state tax perspective, we know that with this sunsetting provision, that estate taxes are going to come from roughly $25 million down to about $5 million. Right? So that's a big drop. So that's something to be thinking about if you have assets, but probably even as important or more important is the long-term care needs, right? So the permanent plans and the IUL with the living benefits, right? Your choices are a couple different things, right? One, you could choose to just use all of your retirement assets as your solution to pay for long-term care needs. But all the money you worked for your entire life, all the heavy lifting with your back, etc.,
just burning it
could
up.
just be burned up on the back end, and the people you'd prefer it to go to. Look, even if you don't like your kids that much, you probably still like them.
Well,
you probably still like them more than the government, right?
Or like my church, or like whatever these. It's like I don't want it to just go to Sam.
Absolutely.
Correct. So with that being said, your choice is to just use those assets as your plan, because everyone has a plan.
Yeah, sure.
Or to buy long-term care insurance, but there are several problems with that, right? You've got, use it or lose it, right? You pay on it, and if you don't use it, you lose it.
We don't sell those, by the way. I
Riddled,
don't like them.
Riddled with rate increases, right? If you go to California Department of Insurance.gov and you punch in long-term care rate increases, you can see every time they've asked and how much it is. And many of the top players have asked for 30, 50, 60, 100% rate increases. I saw one last night was asking for a 140% increase.
I mean, it's all getting expensive. So, I mean, it's justified to a certain degree.
And then when you look at it, so that's also investment drag on your portfolio.
Yeah,
so even
absolutely.
if you choose to buy that insurance and you spend $5,000 a person, $10,000 a couple a year, what does that look like from your overall financial plan? How much yield do you have to give up just to support that additional insurance cost for those long-term care policies that again are use it or lose it, increases, reimbursement,
really
in nature.
expensive.
Totally. There's ones that aren't use it or lose it, but then they come with a big expense up front, and it's like, okay, those are the ones we prefer selling, but that has a big ticket. A lot of people can't just look at it and go, I'll pay it, right? So it's like, it's not a great space right now.
So the long and short of what I'm getting at is, hey, the term falls away, the permanent solution with the IUL, etc., is there, and it becomes relevant in more than one way. It becomes relevant from critical illnesses like cancer and heart problems. And a payout there in your later years. It becomes relevant to the long-term care needs, whether that's in-home care, assisted living care in a facility. Most people don't ever want to go to a care facility, right? And so the best way to not have that happen, to be able to stay in your home, is to have something in place to be able to provide leveraged up tax-free dollars.
And then just real quick, because I know we're kind of getting all over the map, because there's so much to this, and we only have so much time, and this is so fascinating, not only to us, but for all our clients. It works wonders in their lifetime. Stating that the accelerated death benefit is increasing over this time. Your cash accumulation is increasing over this time. So do I understand it where you are now, after all these years, you have an accelerated death benefit, and you can now drag that down before accessing the cash, if your cash, assuming you weren't taking out loans
correct.
during that.
So if you're eligible, if you're unable to perform 2 out of 6 activities of daily living, or you have a severe cognitive impairment, things like dementia, Alzheimer's, things like that, you can access the death benefit, right? And you can, which is a leveraged up number from your cash, right? And you can access that money typically tax-free and it's paid in cash, and it's certified by your own doctor, right? So it's a friendly gatekeeper, which is key. So being able to access cash so you can hire whoever you'd like. You don't have to hire a licensed healthcare provider. You don't have the insurance company doing the certification, which is a conflict of interest.
Huge.
We had, if we had family trying to take care of grandma, and it was like, there's really no way to get money to those people. IUL allows that, right? Because all those plans for long-term care have to be at a facility.
Typically,
and have to be
typically licensed healthcare provider, if either facility-based or at least licensed. And, again, an LVN doing it off of a care.com, right, is probably quite a bit. In my experience, less hourly than someone going through a licensed healthcare provider, yet the care is identical. And at least in my grandfather and my personal experience, that's what we saw. When paying cash, the money went a lot further.
It did.
So just to your point, right, you have liabilities and things kind of come down, but then they turn around for different reasons, from a legacy standpoint, from a taxation standpoint, from a living benefit standpoint. So and then getting to product, right? So with the product, it's to give you a real general 101 on Index Universal Life. So Index Universal Life, right, you have the underlying cost of insurance and then everything else over and above that you're putting into the plan, right, maxing out that envelope that the IRS allows, right, so putting as much money into it as it can over and above the cost of insurance.
And there's an internal algorithm that builds that out for you.
That's that. So then that money is then put into the account, right, and based on an index return, right? So your money is not actually going into the stock market. So a lot of people don't understand that. They think, well, it's the S&P 500, or it's some Fidelity multi-factor index, or it's BlackRock, or it's this or that, or whatever it might be, NASDAQ, Russell. So we actually have 8 different index selections that the client can choose from, as well as a fixed account, right, where it's a declared interest rate. And they can break it into 10% per, 8% per, 25, or they can put it all and say maybe the most popular, which would be the S&P 500. But their money is not going into the S&P 500.
Right.
The insurance company is using that as an indicator of how much interest to pay them on an annual basis. So their money is not in harm's way, right? It is a fixed product, meaning that the money is not going into the market. They're simply using that index to let them know how much interest they're paying. Now, in the background, and we don't need to get into the gears of the watch, we mostly need to know what time it is, right? But some of the gears are, they take a portion of their general account return, the insurance company, and they buy an option. And that option, that with the investment bank, right, then generates the money, right? So if the market goes up, then the client receives that money in return, right, based on that index return. But they are not buying an option. They are not putting their money in harm's way, right? The insurance company is dynamically hedging hundreds of millions of dollars on a monthly basis in an options exchange to be able to do what is fairly complex investing, but in a very vanilla, no brain damage way for the client, right? So it's not something you or I could do individually, but because of the scale, right, of the carrier, they're able to do that for the client. And then on the flip side of that, if the market goes down, the option expires, they've paid a portion of their general account return for it, and no money is lost on the client's side. So we put the money in, it's in the account, it's not in harm's way, right? We choose an index, which we have 8 of, as well as a fixed account. And based on the index performance in that year, the client is credited interest. Then another very key piece of the puzzle is annual reset. And I can't...
This is awesome.
I can't really stress enough annual reset.
I love this.
So 2020, right? Get a nice market return, right? Or index return. 2021, nice rate of return. Then 2022 shows its face, and you lose 20+%.
Yeah.
Right? Which basically takes a lot of those gains right out of the equation. The money you thought you had, you no longer do.
Out. Yeah.
Well, with annual reset and within Index Universal Life, Midland specifically, you have an annual reset. So if it gets a 10% growth one year, now I have 110% of my money. The following year it drops 20%, I still have 110% of my initial amount. The following year, all it does is return halfway, right? So even though it fell 20, we're just coming up 10. Or if you were in the market, you wouldn't even be whole yet, right? You pick up another 10. So now you're at 120, right? Even though the market is still down. So that annual reset is a powerful tool. And what it allows for is over a 5-year, 10-year, 20-year period of time, it basically gives you a strong rate of return with very little deviation.
Yeah.
And it can give you a nice compounding effect, which we know compound interest is important.
It's huge.
When growing money, especially over a longer period of time, things like retirement assets.
I mean, to just simple math, 3 years to get 20% back on average, right? I mean, just if you're getting 7 to 8%, you're trying to get back from that bad year. Really, in your annual reset says after 12 months, you can just basically, it's like it didn't happen. We don't have to wait all that time to get back to your net zero to keep going up. You just reset it. And now you're traveling positive again. That's incredible.
If the market just went up and down 10% every single year, right? So
Yeah.
in effect,
Yeah.
it was tracking zero. But with an annual reset, if I go up 10 and then I'm down, right? And then I'm back up again, you divide it by 2, it's a 5% rate of return, right? And you have a pretty decent amount of compounding that happens with that. So it just smooths out the ride,
Yeah.
right? And allows for a fairly predictable rate of return over time. So with the fact that you've got your downside hedge, a real hedge, not like a bond hedge,
Yeah.
right? But a real zero floor, and you have the upside potential of the index with proven indexes that have performed over 100 plus years that, would just continue to seemingly do what they've been doing.
Right.
And you add that annual reset into the equation with having access prior to 59.5 without penalty, right? And the fact that that money's tax deferred and accessible tax free, and the fact that it has a self-completing component, right? If I put $6,000 in a Roth IRA and I pass away, what does my family get? Can they retire with that $6,000?
Heck no.
No. But we have a self-completing component because of the life insurance, because of the death benefit. So now my spouse is in a better position to hopefully be able to retire even though she's lost me. So it's a self-completing component. Yeah. Also from the living benefit standpoint, right? People texting while driving, distracted driving, accidents, that type of thing, MS, Lou Gehrig's, Parkinson's, all of these debilitating diseases that are out there, hedging that. If I put $6,000 in a Roth and a distracted driver puts me in a bad position, what do I have to live on? $6,000.
Yeah, it's nothing.
Here we can access 96% of the death benefit, right? While I'm alive.
Yeah.
Right off of that $6,000, now I'm accessing the death benefit, which may be $100,000, $200,000, $300,000. So again, self-completing, even if I'm incapacitated. So again, very real benefits, very tangible, real benefits, all encompassed inside of a plan that hedges the market, gives you access, right? Gives you a strong rate of return, and the benefits that everyone wants, they don't necessarily want to go out and spend for.
Sure. I just want to hammer home one point.
Okay.
So we touched on there is a zero floor, right? We can't dip below zero. However, that's almost too good to be true. Sure. So then you say, hey, Midland, how does it really work for you on the gain years, and what's the ceiling look like?
We haven't addressed the caps or the upside.
So let's just address that real quick.
So there are 3 different indexes within our current portfolio that are uncapped. And so basically they are a index that has equities, bonds, and cash that are managed in a way that's determined by volatility in the market, or they're traded. Sure. It's a rules-based program. That is an uncapped strategy, but because of the cash and bond aspect, it's an uncapped strategy because we know that they're not going to have the same type of increase opportunity like a straight equities index would.
Sure.
So there are uncapped strategies that have blended indexes with equities, bonds, and cash. There are uncapped indices like the S&P 500 that have a spread. So basically meaning that the insurance company would get, you would get 100% of the upside minus a spread. So if the market did, let's say 2023, the market's up over 20%. Yeah. The spread might be, let's call it 8%. So the client would get 12, right? They'd get 12%. So they're hedged on their downside, and on a decent size up year, they would see the 12%. Or like the Fidelity index that we currently have, right? Market does 6, it has a par. It might be 150 or 180% participation. So if it does, 5, you might get 8 as a credit. And that's uncapped, but it's uncapped because it has some bonds in it as well. Right. So the idea is that you have several different indice choices. You have an S&P 500 that's capped, say between 9 and 10%, where you get 100% of the participation. We're not going to be able to explain all of them on the podcast. It's too complex, I think the idea that I want to convey or get across is that there are several different options, and you and your advisor will look at those, and you may pick 2 or 3 that have strong historical back testing that you feel confident in and understand, and you apply those to your plan. And then annually, when you get your statement and when you have an opportunity, you can adjust those or make changes based on the environment or your feelings.
Sure.
As well as you have a fixed account if you're not feeling particularly rosy about where the market might be in the next year.
Right.
Although market timing is something that I think escapes most people.
Yeah. It's the time in versus timing.
There you go.
Yeah.
And there's just a couple more things I want to discuss before we get into almost the last segment of business owners and executive planning.
Okay.
I wanted to touch on, I believe this product is a get in as fast as you can, in my personal opinion, because it still is a life insurance product and you have to qualify for it from a
medical
standpoint.
Right.
So stating that, I just want to make sure we're driving that home because I know we touched on it a little bit.
It's important.
You definitely got to be healthy-ish to qualify and get in while you can.
Yeah. I think it is a little different now than it was 20 years ago when I got in. When I first got into the business, diabetes was a big no-no. Now, people who are diabetic, type 2 diabetic, can get a standard health rating.
Because they can get it under control.
So much better.
Yeah.
Correct.
Yeah.
So things like diabetes that were a no before are not anymore. Things like cholesterol, blood pressure, right? History of cancer if you're over 5 years. So I think the underwriting is a lot more.
Loosened up.
It's loosened up, and/or they've just got a lot more
they're
data.
following medical
Right.
trends. It's just we're getting better at treating people.
Right.
Correct. So 100%. I don't want to turn people off and go, oh, well, I have this medical issue, so it's not for me. But there definitely is a medical perspective, and your analogy. Your analogy is correct. The sooner you get in, the better the health rating, the lower the internal expense or investment drag is, right? The better result that you'll have long term.
Yep. That made me realize one more question. What is the cost more or less to manage an IUL, right? You have the insurance cost. What about if you have AUM, assets under management, I hire a wealth advisor, they're going to charge me 1%. What does that look like for a product like this?
Sure. So when you look at the advisory space, right, and you look at money under management, like what you said, anywhere from say 80 basis points to 1.2 to 1.3, depending on the asset size, pretty standard.
Yep.
And then you have your mutual fund fees, your ETF fees, or other package product fees on top of that. So most people, if you really break down what they're paying in investment management, what I see is somewhere between, call it 1.3 and 1.8% on average. And what are they getting for that? Well, they're getting advice. If it goes down, they lose that plus the fee. If it goes up, they get that minus the fee.
Right.
Well, with us, if you looked, I'd say over a 30-year period of time, you're probably somewhere between 1.5% and 2% all in over a 30-year hold, right? And when you look at that, though, it's not just for advice.
That's for the insurance too, right?
It's for the insurance too. So things like, right, being incapacitated, that's a very tangible benefit, right? An untimely early death, that's a very tangible benefit. Because if I'm just paying my investment advisor his, call it 1.5% on average, and then I'm going out and I'm buying separate term life insurance or other permanent life insurance on top of that, right? Well, if I look at my total expense ratio, right, on all of that, it's probably a lot more than the 1.5% to 2% that you're paying inside of the IUL over time.
Yep.
Yeah, I think it's important. We always talk about, hey, you get the life insurance part of it for that expense, and it's really not as expensive as you think for that reason, which is awesome.
That's right.
Kind of to finish up, I mean, we touched on it. I think this is the exciting part for us because we're planning on doing a lot of these strategies internally for the business.
Yeah.
How are people utilizing this for employee retention? How are they using it as business owners?
Yeah, buy-sell agreements.
Buy-sell agreements, because
executive
these are
bonuses.
Executive bonuses. These are things that we want to be able to go, hey, this is the creative side.
Sure.
This is the part where, hey, I don't just have to pay employee a bonus, which comes with taxes and all the other things that they want. Also, people at that level, they're probably making good money, and they're trying to find ways to, how do I creatively avoid some of these taxes?
Yep.
Talk about that, because it is an important part of retention, growth, and having a real way to create wealth within your organization.
And just real quick, to Charlie's point, it's exciting because we're doing that right now for Greyhawk. Stating that we do this a lot for our commercial clients.
Yeah,
so Greyhawk is 95% commercial insurance, especially in the middle market to large space. So this is a key component for us and our clients. So let's touch on this.
So I think, look, a lot of closely held businesses, smaller businesses, they may have 20, 30 employees, right? And when you talk about putting together a 401k or other type of retirement plans, you can't discriminate, right? So the guy that's making 15 an hour versus the guy that you're paying 200,000 a year to manage and run your business, and he's a key piece because he's driving a lot of the revenue that the business is generating, having to treat them exactly the same or having to provide these types of benefits to them can be costly. It's difficult for HR to administer, and quite frankly, just may not be financially realistic to do it for the masses.
Yeah.
Right. So using executive bonus or using a life insurance, as we've been discussing, to be able to provide that key employee or key class of employees with some type of benefit, you're able to discriminate. Right. So I can carve out or pick 5 guys within my organization that are key revenue drivers that I'm saying, look, we're in a situation where the guy down the street, he would love to grab this guy away from me, right? Or this guy's making enough now, and he's complaining that he's paying too much in tax. So if I give him a raise, right, a lot of that raise pushes him into the next tax bracket. He's going to see, not really much difference in his paycheck at the end of the week when he takes it home, even though I'm having to pay him more, right? You have both sides of the social and the FICA, right? So by paying it as a benefit, right, the business owner gets a tax deduction, and then the employee receives it, right? But you're not having to pay the social and FICA necessarily on that benefit on the money that's coming across. So there can be potential tax savings there, right? Also, the heavy lifting from HR, not a concern, right? Having something tailored specifically to those individuals. So of those 5 guys that we're talking about, or maybe 3 guys I'm talking about, I may want to do a few $100s a month for this guy, and I may want to do a few thousand a month for this guy.
Yeah.
So having complete flexibility and being able to put together very tailored plans to be able to retain, pay, and create additional benefit, or golden handcuffs is kind of the phrase that people love to use, to be able to retain those employees and offer them benefits that are meaningful to them, as well as there are different structures from a beneficiary standpoint where the business can be the beneficiary on if something were to happen to them. If they were incapacitated, the business can, have some money coming in so that they can hire someone else to fill in during that time for that loss of revenue.
Absolutely.
Or if that key employee were to pass away and now they're without that revenue until they can find someone to come in and possibly, hopefully replace it, they've got that death benefit that pays to them. So there are different ways of ownership, and also gives them control of that asset, even though they're funding it for the client, on ways to be able to hold on and even provide it as a pension.
Right. And we talk about a vesting schedule, right? Like, we will do this. There is a vesting schedule. So after X amount of years, if you decide to leave, or if you do pass away after that time period, your family gets it. Like, there is a lot of things that you can do to create that, like, well, what does that look like in 10, 15, 20 years on a wealth basis to that person?
Right.
So if you leave at year 5 and it's a 10-year vesting schedule, it's gone.
100.
There's nothing that you can do.
Yep. So, just working with you guys and providing, those employers and businesses that you work with, the knowledge to be able to set up different plans, right? To be able to structure it individually and tailor it so that it fits their needs, and being able to adjust it as they grow. I think that is, it's definitely unique, and it's something that will separate your business from, the business down the street. And with things like vesting schedules and other key benefits like that, can be invaluable to those employees from a acquisition, right? Because you may be, just like they're trying to get your employees, you're trying to attract other people, and by having some of these things on board, it can make you a lot more attractive in your perspective space.
Go ahead.
I think from my perspective, I always think Greyhawk has this: how much can we give to our people? They are our biggest asset, truly. I think a lot of other businesses feel that way too, and they're really trying to give people that, like, hey, I don't just want to retain you and put golden handcuffs on you. I do want to build wealth for you, because I'm only as attractive as what I can give people to build a career, a future, wealth. And I feel like it's a really important piece of...
And we've been spending a lot of time on this, because there's the tangible and intangible benefits, if you will. So this is a very tangible one, but we're even going beyond just all the typical 401k, health, this benefit on IULs and executive bonuses. we also are talking a lot about the intangible stuff because that is our best asset, are our people.
Sure.
Yeah,
Absolutely. So we just think it's another way to love and care for the people. And look, we're selfish. We want people to stay with us,
Of
and it's another good
course.
way. But we
Yeah.
aren't only doing it for us.
Yep, it's
In our
for
case.
them.
Yeah.
So I think that was a great segment. I to wrap it up, Hobie, I can't thank you enough. We've worked together for a while. I hold you next to none in this space. I've been in plenty of meetings with you with some high net worth individuals, and they are just fantastic to where I get the phone calls afterwards, and they're like, we're so impressed with that presentation. So from our standpoint, again, I can't thank you enough. And this is a biased, humble opinion. This episode is great right here.
Absolutely. Thank you for coming again. We'd love to have you back in the future and even go further because there is still so much we didn't touch on.
Look, I mean, it was a little squirrel ride. We're here, we're there, we're here, we're there. You know, but there is a lot to cover. I think we definitely.
And we broad stroked it.
We did.
Yeah.
And, you know, leaning into it individually as, you know, with your individual clients or picking a specific space and us just focusing on that in future episodes, I think would be a valuable, you know, or worth everyone's time.
Absolutely.
But appreciate you guys having me and the kind words.
Absolutely.
Thanks,
Well, everyone,
Hobie.
thank you again. We'll see you on the next episode of the Risky Assets Podcast. Take care.